Today, I want to talk about something that plays a huge role in long-term investing, but doesn't always get the spotlight it deserves, and that is corporate earnings. As we move deeper into earnings season, investors are shifting their attention away from big geopolitical headlines and towards the actual report cards companies are releasing. And with the market sitting near all-time highs, understanding what these earnings reports really mean is more important than ever. Let's break down what's going on. As we enter the final stages in the reporting season, Wall Street forecasts suggest that companies wrapped up 2025 with solid growth. In fact, earnings per share for the S&P 500 are expected to hit a new record. Think of earnings reports like school report cards. They show how well a company is performing, whether their strategy is working, and what that might mean for future stock prices. Professional investors rely on these numbers because they ultimately help determine how both stocks and bonds are valued. Here's the key point. For long-term investors, it's not about one company's results. It's about the overall earnings trends. Because those trends tell us a lot about bigger forces like economic growth, consumer spending, business investment, and the overall health of the market environment. Corporate earnings are really the bridge between the economy and your portfolio. When the economy is healthy, strong job market, steady consumer spending, solid business activity, companies usually see higher sales and stronger profits. And since owning a stock means owning a share of those profits, stronger earnings tend to push share prices higher. This isn't just true for individual companies. Over long periods, the entire stock market tends to follow the path of earnings growth. A big reason the U.S. stock market has risen over the years is simply that the U.S. economy continues to grow steadily. Here are a few current stats that show just how strong earnings have been. As we enter the second week of February, more than half of S&P 500 companies have shared their fourth quarter 2025 results. 80% of them beat expectations, according to FactSet. Overall, earnings per share for the S&P 500 are expected to grow 8.2%, marking the 10th straight quarter of earnings growth. Looking at the full year, earnings grew about 13% in 2025, and forecasts call for around 15% growth in both 26 and 27, well above the long-term average of 7.7%. If those trends continue, we're looking at a very supportive backdrop for investor portfolios. Earnings season is also important because it helps put valuations in context. Valuations tell us how expensive or cheap the market is relative to its fundamentals. Kind of like whether you're paying a premium or getting a deal. Right now, the S&P 500's price to earnings ratio is 22.2 times. Compared with a long-term average of 15.9, that's high, and it's not far from the dot-com era peak of 24.5 times. The good news is that today's valuations are supported by actual profit growth, something that definitely wasn't the case during the dot-com bubble. This connection matters because short-term market volatility often has nothing to do with earnings. Prices may bounce around, but underlying earnings expectations might stay the same. And when the fundamentals are intact, markets often rebound quickly after pullbacks, which is why staying invested or even adding to positions during dips can pay off. A quick example from last year. The S&P 500 gained 16.4% in price terms. Earnings grew 13%, meaning 80% of that return came from real profit growth. Only about 20% came from higher valuations. That tells us that the market's strength hasn't been just about enthusiasm, it's been about actual performance. Another major factor influencing earnings and investor expectations is the surge in AI-related spending. Companies are pouring money into data centers, computing hardware, and the broader infrastructure needed to support AI. These heavy investments are being led by the hyperscalers, which are the big players with massive computing capacity. The potential upside is significant. If AI adoption continues to grow, these investments could strengthen earnings over the years. But if adoption slows or stalls, it could squeeze profit margins in the short run. At the sector level, earnings growth expectations are currently strongest in information technology, which makes sense given the scale of AI investment. AI's long-term impact on productivity and economic growth will take time to fully develop, so long-term perspective is more important than ever. The bottom line is strong corporate earnings have played a major role in supporting the stock market gains. Even with ongoing uncertainty and elevated valuations, the fundamentals remain solid. For investors, this means you must keep a long-term focus, maintain a balanced portfolio, and don't let short-term noise drown out long-term trends. Because at the end of the day, steady earnings growth has historically been one of the most reliable drivers of long-term wealth creation.